The next 6 to 12 months is gearing up to be a firecracker in the stock market. We're going to break it all down. Now, a lot of people did miss buying the dip, or I should say the crash, in April, and we just made an all-time high on the Qs, an all-time high close on the S&P 500, and we have a golden cross right here on the triple Qs. I'm going to get into what does that mean. We see this every single time the Qs make a golden cross between the 50 and the 200 moving average. And the good news is that there are still some stocks lagging behind that I don't think the stock market can make new highs without. So we're going to talk about some of those laggards and where there is an opportunity to capture some tremendous value and hopefully ride the wave on the backs of some of those stocks as the market inches higher into new high territory. So let's first dive into the important headlines, and then I'll talk about the stocks towards the latter part of the video. Some news came out of the White House today that says the White House signals July 9 trade deadline may be extended. Now, this isn't a secret. We've talked about it before, but it's obvious that the Trump administration has pulled back on their aggressiveness with regards to the tariffs, and I don't think anybody takes the tariff hemming and hawing seriously anymore. So this right here isn't a surprise at all. I mean, the market pretty much signaled as much when we rallied significantly above the Liberation Day drop. Aside from the Trump administration taking their foot off the pedal, some breaking news just came in that apparently we have a trade deal with China.
The press was saying, do you really have anybody of any interest? Well, we just signed with China yesterday, right? Just signed with China. We have everybody. We're not going to make deals with everybody. Some we're just going to send them a letter, say thank you very much.
So apparently we signed a trade deal with China yesterday. I'm recording this on June 22nd. So apparently Wednesday, June 25th, we signed a trade deal with China and nobody knew about it. But Trump just announced it right now after market close on Thursday, June 26th. So aside from the fact that the tariff risk is basically behind us, so is the geopolitical risk with the tensions between Israel and Iran, as the White House is pushing for a permanent ceasefire. There's also something on the table that a lot of people forgot, and that is the tax bill. So what they're calling the big beautiful bill is likely scheduled to be signed by July if everything goes well. Now, the Republicans control the House and the Senate, so there is an expectation that it will get done sooner rather than later, even if they have to argue on a few points in the bill. Now, the last tax bill that was signed back in 2017 unsurprisingly rallied the market. Why is that? Well, it's because it gives a tax break to people who actually buy stocks, which is the top 5-10% of the country. Anytime you give rich people liquidity, they're going to buy up assets and throw their money into the market. Not only that, but you're also providing liquidity to businesses as it lowers the burden, the tax burden on those businesses. Now, remember how on this channel we talked about how retail traders were fueling most of the rally from April and how institutions were actually underweight? Well, this just came out today by Bank of America showing that institutional clients' net buying of tech stocks last week ranks as the #1 in history. Now, if you look at this, 2021, which was a very bullish year after the pandemic drop, that was the last time that we saw levels like this. So if we are signing trade deals with the likes of China, if we are basically willing to push the trade deals with the rest of the countries, kick the can down the road, if the new tax bill is signed, fueling spending and liquidity, and if you look at the past 10 years and 20 years, July is actually one of the best months in the stock market, only second to November. This also happens to be true in a post-election year, as you see the dark blue right here. And you can see that global fund managers, this is from Fundstrat, Tom Lee's company, you could see that global fund managers are actually underweight US stocks. Remember all of that chatter about the de-dollarization and the US losing prominence and how other markets were a much better place to invest? Yeah, when tech stocks start rallying and the Mag 7 starts rallying, all that goes out the window and the fund managers come back and the institutions come back and they start plowing money into stocks, driving them higher. Now, like I said, we just hit an all-time high on the Qs, all-time high close on SPY, and we still have a few days left in June, but we could pretty much surmise that June is going to end green. I think we're up 3.5% this month. Here's what happens when May and June are both green. The track record is absolutely stellar, and this is why I was saying in the next 6 to 12 months, it is your responsibility to find positions in the market that are still lagging in order to ride on the backs of those stocks to new highs. So when May and June are both green, we've done this several times. You can see only once in 2018 were the final final 6 months actually read. The average return for the final 6 months is 8% overall, and this happened 94% of the time. The next 12 months is even higher at a 15% average gain at an 87% hit rate. Now, let's go back to the Qs for a second. As I said, you could see here the golden cross on the Qs. I went back and looked at history all the way since the Q started in 1999, since this ETF started. Only one time in history were we not immediately greener and by a wide margin, and that was in the double dip correction of 2015. You can see here when we had the golden cross, we did a double dip, but from that point we then rallied 100% higher before the correction in 2018. Now, the last time we had a golden cross was in 2023, and the market ended up almost 90% higher before this tariff drop here in 2025. Now, what's pretty amazing is we are at all-time highs with some of the Mag 7 still lagging behind. Notably, Google's lagging behind, Amazon is lagging behind. This is a big one that we just took a position in, and we're up 70% on these calls. I'll talk about that position in a second, but Amazon is lagging behind, obviously due to the fact that it has the most tariff impact out of all companies, probably Amazon and Apple together, right? Speaking of Apple, Apple is still lagging behind, and this has more than just a tariff impact. This also has to do with the fact that it is the only company out of the Mag 7 that is really lagging in terms of AI. Even Google has a better AI story than Apple. So the market is at an all-time high when the stocks that typically rally with the market are not at all-time highs. This is why I said in the beginning of the broadcast that there are still some laggards that I think the market cannot really continue to significant highs without. So here are some stocks that I'm super bullish on to make all-time highs once again. Amazon, there is no secret here. I mean, Amazon is doing better now than it was when it was at all-time highs. Its cloud service continues to grow. It is the #1 cloud provider. If there's no longer that tariff risk with China, where most Amazon products do come from China, all that while its PE ratio is still in the mid-30s. We all know when we look at PE ratio, we don't look at this stuff in a silo, right? There isn't a good or a bad PE ratio. It should be relative to the company and the business that they're in. And if you look at the PE ratio of Amazon throughout 2021, we were routinely trading in the 60s to 70s. And as a matter of fact, historically, Amazon has had a very high PE ratio. So this is, as a matter of fact, when the company's doing its best, the lowest PE ratio range that Amazon has ever seen. Now, we bought calls on Amazon, as I told you I would the last couple of videos, and those calls right now are up 70%. Those are shorter term dated calls, July 25th. But as I told you in my last couple of videos, you can even consider buying leaps on stocks like Amazon and Google when they dip. Which brings me to the next stock, which is Google. Does this pattern look familiar to you? Yes, this looks exactly how AMD broke out after we had dubbed it the advanced money destroyer. Now it is the automatic money dispenser, but a very similar pattern where the story on AMD was that it was just dead weight along with the likes of Intel. But we're going to talk about AMD in a second, but just peep this pattern here. And if you compare that with Google, it's a very similar breakout story. Now, different business models and different levels of fear, but the narrative here is that Google search is dead. However, let's break this down a little further. Not only is Waymo currently the only real robotaxi on the road right now, Waymo plans to at least double its fleet by the end of next year, and they just signed a deal with Uber to operate in Atlanta. YouTube does more viewership time on TV than Netflix. By the way, shout out to Joseph Carlson for condensing these stats. I also told you that YouTube is just as valuable as Netflix is as a company. It is also the second most popular search engine, the first one being Google. Google maintains its spot as a top 3 cloud provider. You have AWS, Microsoft Azure, and Google Cloud, growing 30% year over year. And contrary to popular belief or anecdote, Google Ads and Google Search is actually growing. If you include the very smart and necessary decision to introduce AI into their Google searches and the fact that it is trading at a laughable 17.7 forward PE, while sitting on $132 billion in cash from operations. This is just a criminally underrated company in my opinion. It is definitely a laggard and definitely a part of my portfolio moving forward. Now on to AMD. This is one that I had initially dubbed the advanced money destroyer, as it tanked from a high of above $225 all the way down to 76 bucks, and it looked like the strongest downtrend in history out of any stock. I gave you guys this back in April and May. Go back and watch the videos, or even the last top 5 stocks to buy for June. From a technical perspective, AMD looked great, but then the fundamental picture started coming together as well. I talked about this in my last video, the top 5 stocks for June, when I made that one, but I said the MI355X GPU, which is a consumer grade GPU, is competing with the NVIDIA B200, and especially in the way of inferencing, which is the real important way, the real meat of why a GPU is valuable when it comes to AI processing, that it beats the NVIDIA B200 in inferencing, citing up to 20% better performance for DeepSeek R1 and 30% better performance for a 405 billion parameter Llama 3.1 model compared to NVIDIA's B200. It is also cheaper than the B200. As you can see here, the cost of inference, AMD notes that the MI355X's inference advantage can translate up to 40% more tokens per dollar. Now, what does this mean from an investment perspective? I talked about this last time. It's funny how fast these things move, but I said that NVIDIA has a $200 billion market cap. As of today, it's now $232 billion. NVIDIA has the widest moat in the GPU space, obviously. But if AMD can serve up some of that demand, right? Because we always hear that NVIDIA cannot produce chips fast enough to meet demand. So if AMD is actually producing a competitor and at a cheaper price, then what if AMD takes up a proportion of that market share, or that total addressable market? It has a much better chance, in my opinion, as a company of doubling its value than something like NVIDIA, because NVIDIA is already the most valuable company in the world, and going from 4 trillion to 8 trillion is a lot harder than going from 200 billion to 400 billion. So it's funny that NVIDIA did hit a high of 226 back in February of 2024 before any of this, right? It really was just based on the hype of AI and the hype of GPUs, but it did not deserve that valuation. Now, NVIDIA's earnings do come out in August, and it'll be very interesting to see if they provide guidance for this new chip that they just released a couple of weeks ago. Because if the market deems that AMD is actually capable of capturing some of that total addressable market and some of NVIDIA's market share, it will be seen as a viable number 2 in the space. Then I think there is an extremely compelling narrative for AMD's run back to where it used to trade when this wasn't even part of the story. Another stock that's breaking out from a technical perspective, but from a fundamental perspective is an almost perfect company, is ASML. Now, you guys know the way that I invest. I'm a huge fan of companies that have wide moats, and more importantly, companies that are actually monopolies or near monopolies in their space. Hence, when I gave you guys Uber, which in my view is a near monopoly in its space. ASML is a monopoly, not a near monopoly. There is no other photolithography company that is doing what ASML has been doing for the last 30 years at scale. And it'll cost semiconductor companies so much money to retrofit their systems for a new photolithography competitor. Like, say ASML competitor comes out of China or even out of the US and says, hey guys, we can do what ASML does. It will cost millions of dollars, in some cases billions of dollars, for semiconductor companies such as TSMC to retrofit their supply chain in order to produce chips using a new lithography system, while ASML's tried and true method has been in place for the last 3 decades. Now, a sleeper pick here is a short on gold. You can see that gold has been on an absolute tear this entire year, as we dealt with tariff fears, as we dealt with rising yields, as we dealt with geopolitical fears, right? Gold is the ultimate commodity. However, what happens with gold when volatility drops and fears are out the window and there is a resurgence of buying in the stock market, and we get one more year of a bull rally, which all of the data indicates, then you could see that even in hyperbull markets, gold actually tends to go from being a store of value during times of fear to actually dropping off in favor of investing in the hyper growth that the stock market provides, right? Not only that, but if you take a look at the dollar, which runs inverse to the gold, the dollar has absolutely tanked to the lowest levels not seen since 2020. 2022. And if we take a look at the dollar, even from the weekly perspective, it is almost at an oversold level. So if we do get a bounce in the dollar, then like I said, the dollar and gold move inverse, then that might provide a really generational shorting opportunity on gold. But for now, we are still holding this trend line. I would need to see a definitive break below this trend line for that thesis to come into play. And lastly, I just want to talk about the fears as we near all-time highs. There tends to be this irrational fear that once we hit all-time highs, the market is going to tank. Now, obviously that is fueled by some logic, as we tend to see some profit taking at all-time highs. But if you take a look at the data from the last 40 years, and I asked Grok this, you can see that there is really no conclusive data showing that the market drops after making all-time highs. As a matter of fact, there is usually a positive 1-year forward return 70% of the time of 7 to 10% gains after the market makes a new all-time high. That is not to say that the market won't pull back. As a matter of fact, I'm a huge fan of the prospect of the market pulling back, as we still have quite a few gaps left open between May 9th and May 12th. As you guys know, I was hoping that we would address that before hitting an all-time high. Not really hoping, but I was ready for it. However, if we do get a strong July, as is the case when we talk about seasonality, especially in a post-election year, you could see that August and September are typically weak months. That could be something that can be addressed later on in the summer. And the prospect of a recession in 2026 is not lost on me. As you can see here, the 10-year and 3-month yield curve still is, it's uninverted kind of, but we're still sitting at around 0. What happens once that yield curve steepens once again and the 10-year is comfortably above the 3-month? This has been a perfect recession indicator each and every time, but you could see that usually it takes about a year or longer for a recession to hit once the yield curve is comfortably uninverted. And because we had those tariff fears, we heard Jerome Powell the other day saying that that is why we did not see more cuts this year. However, Morgan Stanley expects the Fed to deliver 7 rate cuts in 2026. As you guys know, when the Fed cuts, it's typically because there are signs of something breaking. Either unemployment is starting to mount and trend higher than it has in the last few readings. We are also seeing quite a few layoffs that I think is not talked about a lot, but there are quite a few AI related layoffs, as a lot of these tech companies are finding that they don't need this many human employees because AI will take care of a lot of the jobs, such as junior developers, QA analysis, etc. So I wonder if the progression of AI gets to a point where in 2026 we start seeing mounting job losses, and that starts to have an effect on the unemployment numbers. Who knows? Also, don't forget that driving related jobs are the #1 jobs in the United States. So as we develop these autonomous driving systems more and more, I'm sure that we will see quite a few mass layoffs of driving employees or employees that have jobs related to driving. So it's not lost on me that there are still recession fears ahead. I'm really just talking about what the data says within the next 6 to 12 months and what opportunities are there for us to take advantage of from a trading and investing perspective. And if you've been watching this channel, just following along, you know that we have absolutely killed it this year, buying quite a few stocks back in April and May. But if you want to take your trading and investing to the next level, make sure that you join the Traveling Trader Academy below. Shout out to our super member, Serrano. You can see here, he sent me this message. This is when he joined the Discord back in July 2023. And you could see even before then, he had modest gains in his portfolio. Supercharged this to where his portfolio has now, it looks like based on this scale, 2 to 3x here. And my personal portfolio has hit an all-time high. You could see that here. And I'm transparent with everything that I trade. I send those alerts in the Discord as well. So if you want to trade live with me every single day, I go live at market open. I trade futures and options every day at market open. And then throughout the day, I send my swing trades as well as my long-term stock picks and long-term analysis. We are also reopening the doors for the mastermind. This is the lifetime mastermind subscription, which is closed to the public. It is now accessible only via application. You have to apply if you want to get in. The doors open on July 1st. You can apply now. And on July 1st, we're going to be sending out our acceptance and rejection letters based on how you answer the questions in the application. If you are accepted, you'll know, and you'll be sent a link on how to join the lifetime mastermind. The mastermind classes themselves are taught by me, and they start on July 9th. They run for 4 weeks, 2 classes a week, teaching you A to Z, how to trade, how to read a chart, how to set up your day trades on futures and options. So sign up below. Make sure you apply if you want to get in. Let me know down below what you think the market is going to do from here and what stocks you are interested in. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.